Okay, what is Bitcoin? Bitcoin is the first engineered monetary system in the history of the human race. Full stop. So now to explain it, the first question is, what's money? The second question is, what's the problem? And the third question is, what's the solution?
Right.
Bitcoin is the solution. Now go back to the beginning. What is money? Well, an economy consists of goods, services, and property. You know, I want you to do something for me. I want that product. I want you to manufacture something for me. I want that house. I want that land. That's half the economy. Now the question is, how do I send 37 horses to you, and then how do we keep the books balanced? So you have to send me back money. Money is socio-economic energy. Money is monetary energy, or it's the energy, the backhaul energy that we use to trade with. If I can send you 10 bushels of corn and you can send me money equal to 10 bushels of corn, then we can trade with each other. So in the history of the world, human beings have tried different monies. We've used seashells. We used the giant stone coin of the Yap people. We used tobacco bales in colonial America. We've used copper coins, silver coins. We've used stone coins. We use glass beads in Africa. These are all types of money. Eventually, we got to settle on gold and gold coins as money, but gold was never fast enough as money. How do you move 10 tons of gold from here to there? So ultimately, people used ledgers, and those ledgers were issued by a merchant, or they were issued by a mayor, or they were issued by an emperor. And you know, you can go back 5,000 years and you can find Sumerian tablets in clay where they've etched in like 37, bushels of oats in return for something. These were the ledgers. So money is that shared ledger of who owes what to whom. And a lot of times the money is a token, like a glass bead. But the problem with a glass bead is, if the Africans use a glass bead and the Europeans show up and they can manufacture 1 million glass beads, the Europeans dump 1 million glass beads on the Africans lose their homes and their livestock and all their wealth, and they're impoverished. So if you have weak money and someone else has strong money, if they can manufacture the money, like in the Pacific Islands, they use stone coins. Some European showed up in a ship and he realized that stone coins are rare on one island, but they're very plentiful, big stones on another island. He sailed to the other island, picked up the stones, brought them back to the first island, and enslaved everybody on the island. It's like, problem. So the problem with money is, how do we keep track in a fair distribution of who owns a claim to what? If there's $100 million worth of capital in the economy of products and property and corporations and the like, you have to have $100 million of money. Now, if I issue $100 million of currency, it equals all the stuff in the economy. Now, if I start to inflate the currency and I issue another $10 million,
yes,
now I've taken 10% of the economy and given it to my friend. That's the inflation rate. If I keep inflating the currency, if I double the amount of currency, but the amount of stuff in the economy is constant, well, then the price of everything that's scarce and desirable doubles.
Yes.
Okay. If it's not scarce and desirable, it won't go up. But if there's 100 things and there's 10 times as much money, it stands to reason that the things cost 10 times as much. So money is economic energy. The problem is inflation. Because in the history of the world, we have inflation. When the Romans created gold coins, they start with a certain amount of gold, and they would debase the currency, right?
Yes.
They would cut the amount of gold or cut the amount of silver in the coin, and when they cut it to a small enough level, no one would take the coin anymore. So the mercenaries don't want the coin, the emperor can't pay the mercenaries, the empire topples. If I just issue you paper, whatever the paper might be, and then I triple the supply of the paper, eventually the currency collapses. So the problem with currencies in the history of time is the trust in the issuer. You're trusting an individual, right? You're either trusting a banker, a J.P. Morgan, or you're trusting a family, the Rothschilds, or you're trusting a king or a prince, or you're trusting a mayor, or you're trusting a government. Now, if we look at the modern era, economists like Saifedean Ammous, who wrote the Bitcoin Standard, he estimates that the inflation rate in the modern era, dollar weighted, is 14%. Okay? Think about that. For the last decade, on average, all in the world, we've been inflating the currency by 14% per year. Now, it happens that that's equal to the rate at which the S&P 500 index is going up, 14% on average a year for 10 years running. What's the issue? Well, what is inflation? It's not really well understood. Some people think it's CPI. CPI is the rate at which a market basket of consumer goods is going up, but the government gets to pick the basket.
I've noticed.
Okay, if I pick things like Domino's Pizza and streaming YouTube videos, they will never go up in price. I can actually adjust the basket, so I just pick things that don't go up in price. The Case-Shiller index is up 27% year over year, in July. So the price of that average single-family home is up 27%. Homes in Canada up 15%. The S&P index is up 34% this year over 12 months. What's the inflation rate? If you wanted to buy a basket of desirable stocks, the inflation rate is the S&P index. So I can calculate any inflation rate I want. Inflation is a vector. If I want to be rich, then I need to buy scarce, desirable assets. So my inflation rate's the rate at which Picasso's and Leonardo da Vinci paintings and stocks and property in New York City is going up in price, or a house in the Hamptons. That's a high inflation rate. If I want to be a consumer and live in my parents' basement and order Domino's Pizza and take Ubers and watch Netflix and stream YouTube, the inflation rate will be the CPI. It'll be very low. So you can have any inflation rate you want. As a practical matter, the best inflation rate for an investor or for anybody that wants to stay wealthy or be wealthy, if you're concerned about maintaining your economic purchasing power, it's the monetary inflation rate, the rate at which the supply of money is expanding. The supply of money expanded maybe 10% for a decade before COVID, and the S&P went up 10% a year. We know the money supply expanded 30% post-COVID. The S&P is up 34%. The Fed stepped on the money printer. The same with the EU Central Bank. In the Western world, in the strongest countries, we see the money supply expanding 20, 25% or more per year. The currency is collapsing. It's losing its value. It's being devalued. In weaker countries, go to Argentina, the official inflation rate's 45%, the unofficial inflation rate's 85%. Go to Venezuela, the inflation rate, the currency's collapsed 98%, 99% in a year. Same in Lebanon, 90% currency collapse in a year. So what you have right now going on in the world is currency collapse, which we call inflation. And the mainstream view of inflation is it's only CPI, and sometimes it's PCE. It's an index of things not including the highly volatile food and energy.
Right.
But in what universe can you live without food and energy?
Exactly.
But it's not really good. Like, common sense says, if everybody tells me inflation rate's 2% or 5%, but the houses are costing 20% more, 15% more, and everything, if you talk to anybody that manufactures anything, they'll say that the prices are up 20%, 25% year over year. So how is it I'm supposed to actually buy something? How do you buy a share of stock that went up 34% a year when you got a CPI adjustment of 2% or 5%?
So it sounds like the people causing the inflation are lying about the inflation.
Classically, I just first of all, if you define inflation as the CPI, you're using simple arithmetic to describe the economy. You can't describe the economy and model it with simple arithmetic any more than you could describe fluid dynamics or aerodynamics with simple arithmetic.